All right, everybody, welcome back. So, in the previous videos, we've talked about where the VIX gets its information. And we talked about the options in the VIX coming from VIX futures. I've also talked about how there are a lot of different VIX products out there. And one of the things that we want to focus on in this video is the fact that there are a lot of different volatility indexes like oil or gold or the European currency volatility. And this is really cool because there's a lot of different things we can do with volatility, right? It's a forward expectation of risk, of movement, but we want to know where those calculations come from, right? If VIX is nothing more than a calculation, we need to know where that data comes from. For the VIX oil futures or the VIX oil index, for an example, it comes from the USO ETF. Gold is from the GLD ETF, right? And the FXE is what is used to do the volatility in the euro currency. You always want to ask that question whenever you see anything that's a VIX product. And there's like UVXY and TVIX. Always ask that question. What is the underlying product? How is this thing being calculated? If you don't know where the calculation comes from, you're blind. You have no idea what the underlying product is really looking like or anything. You just have no idea what's going on in that product. The TVIX is an absolutely manipulated product. That's the one that's owned by Credit Suisse. And they were not shy when they published their articles talking about their authorized participants who are allowed to go in and bid up or sell off the TVIX to change its pricing model. All right, that's how they were able. That's the only way they were able to get things figured out because they didn't have an underlying. Okay, you gotta understand anytime you look at a volatility product where the formula is focused. So in my watch list, I have GLD and I have USO. I don't normally look at FXE, although now that I see this, I might, right? The euro currency is not really something that I watch. It doesn't affect me as a trader very much, so it's not really something that I've kept my eye on, but perhaps I will now be looking a bit more at that. But I watch gold and I watch the oil markets using futures and the ETFs. And it's just something that I've done when I'm trying to figure out what's going on. When a market starts to sell off, I'm trying to gauge if it's just a intraday sell off or if it's more of a broader market sell off. And so, those have been in my list. But from this, we've talked about the 30-day expiration and the 30-day expectation of movement and going forward what we could expect in the model of the SPY and how far it could move. But let's go in now and see what else there is. You can see in my volatility watch list that I have VIX 3M. That's the 3-month VIX. And then I have VIX 6M. That's the 6-month VIX. And then I have VIX 1Y. That's the 1-year VIX. Now, why would I want these in my list like this? Well, if you're looking for contango or backwardation, you can see it at a glance just really quickly. You can just look over and say, oh, yeah, no, it's okay. We're in contango, right? Things that are near in time are lower than things farther out in time. All right, great. But here's the problem with that. Remember that VIX is based on the S&P. VIX options are based on VIX futures. Okay, so let's go look at the VIX futures right now. So in the VIX futures, we have right there, we want to look at the contract and we want to look at the price. The active contract right now is the October series, and it's worth $30.10. Okay, let's go out 1 month to November. So from 30.10, we've got November 30.76. So November's more expensive. Good. But then we've got December 30.15. Uh-oh. The November is higher than the December. That is backwardation. January is lower than all of them. So all of these are higher than January and February and March. April, May, all of these farther out options are a lot lower, or not options, futures contracts are a lot lower than the current contracts. We are in a major backwardation. Okay? We want to know when this is going on. We want to understand how this affects us as traders. I don't know how many of you may have heard about the interest rate, right? And the interest rate curve, and how it can be an inverted curve. It comes from this same pricing concept that things farther out in time should be more expensive than things that are closer in time. And that when it is inverted, when we are in an inverted yield curve, things that are close in time are more expensive than things that are farther out in time. Now, a lot of people's heard of that curve and yet have still never heard of backwardation and contango. Just remember that when things go in their normal order, when things close in time are cheaper than things farther out, that's the normal way of business, and it's called contango. We like to be in contango when things are normal. When they're inverted, it's called backwardation. That is when things near in time are more expensive. Okay, we are in backwardation, and at some point there has to be an inversion. It has to turn back around again. So we want to keep our eye on this. Remember that as the futures get close to expiration, and as VIX options get below a certain time period, they do start to reflect the chart. So the options might start with a calculation based on the VIX futures, but once it drops too close in time, it does start to reflect the price of the chart itself. Okay. So the main takeaway from today's video is that if you're going to look at things like the TVIX or the UVIX or anything else that's out there VIX related, you really want to understand where it comes from, what the underlying product is that's being calculated. So it looks like there is no more TVIX, which I'm sure they're going to come up with some new thing. You can see that it got delisted back in June of this year. And this is important to understand that when it comes to things that normalize and mean revert, that a lot of times they don't last. They'll get delisted, and then a new product will get formed. So now we'll just be wondering what new product Credit Suisse is going to come up with. And I still don't think I would be interested in trading it, but keep your eye on things like this 3x gold ETNs, right? Anything 2x, 3x, 4x, or short or inverse, anything that has an ETF or an ETN, you really want to have a strong understanding. Where the heck does it come from? Where's the calculation? Where's the formula? Who owns it? Who made it? When was it made? And look at the prospectus that comes with it, because they'll give you a ballpark or a benchmark on what they think that thing is supposed to do. They'll talk about its normalization. They'll talk about how it reverts and when it resets and when the formula begins again. So you can't just go trade all this stuff like, oh, I see candles on the chart, I'm going to go trade it. Maybe on a day-to-day or an intraday basis you can do that kind of stuff. But if you're going to swing trade a volatility product or an inverse product or a double, triple leveraged product, you better understand where it comes from, what the formula is. You have to. You have to be able to grasp that. Otherwise, you're the fool trading blindly, and all the other people out there are just looking to take advantage of you because they can see a sucker coming from miles away, right? So, short, sweet video. This document, I've been trying to think about how I'm going to share this document with everybody, and I really believe that the easiest way to do that would be to refer you to where it came from. It came from the CBOE. It's their Volatility Index PDF document. It's the VIX white paper. So when we go back in here, let's see, we'll go from here. I believe we went to the OIC here, and then we scroll down into their white papers. So give me just a second. Let me scroll through this stuff again. All right, it took a few minutes getting around the OIC. Can be a little tricky, but you want to find the white papers listing, and I'm going to post this link with the video. This is the white papers, all of their white papers, and the one that you want to focus on is the CBOE Volatility Index, their PDF document right there. Okay, now they have a lot of things on here that you can go through and you can learn and you can read all about. Please trust me when I tell you I'm not going to go through every one of these because we don't need to, not for what I'm trying to help you guys understand. But if you want the document that I was showing here, the CBOE Volatility Index PDF document, this is where I got it from. And of course it's free. They want you to trade their product. They want you to understand their product too. So they give it away. This is a white paper discussing what it used to be and what it is now. And that's where I got it. So scroll down, the CBOE Volatility Index VIX PDF document right there. That's the one that you want. And then you click that or click this and it'll get you there. And I'll just make sure that I post that with the video. All right, guys, I appreciate your time and I look forward to seeing you at the next one.